Those new FDIC rules broadening the pool of who's eligible to buy failed banks. It's expected to make it easier, some say, for private equity firms to make deals. John Canis's private equity firm bought Florida's Bank United from the FDIC in May. He is the former CEO of North Fork, and he joins us here along with Jim and Rich. John, good to see you.
Good morning, everybody.
Some would say, well, could have been worse. You guys should be happy. You don't see it that way.
Well, it's great news for large strategic banks who are the obvious competitors in this business. It requires private equity to hold roughly double the amount of capital that their competitors will have to hold in the same situation. It singles them out as a category, and it's not going to make it any easier. It's certainly not going to access more capital from the sector for what we think is an ongoing problem and going to continue on for some time.
Is it enough to squelch some deals, to have some firms say, we would have done this otherwise, but now no?
I don't think so. I mean, I think that private equity managers will continue to look at this sector, but it will clearly be reflected in the price. The FDIC will, as a result of having to keep higher capital levels, will see lower prices coming from that sector.
I mean, the reasoning, I'm sure they would argue, is how can we trust you guys, right? I mean, you guys will come in, you'll flip it, you'll move away. You guys aren't disciplined. We're going to impose some discipline on you.
Well, there's no evidence of that in the banking sector. There's only been, out of 81 bank failures this year, there's only been 2 that have been successfully acquired by private equity groups, ours and one other. It's difficult to make that argument. Also, we need to remember there's only about 1,800 publicly held banks in the United States. Most of them are held privately today, and there aren't these kind of restrictions on other private owners of banks across the country. Probably 6,000 banks or so that are not under this regulation. So time will tell, but I think that this will have somewhat of a chilling effect on our participation.
Would you have done the Bank United deal under these terms?
Probably we would have bid a different number. It's not for me to say whether we'd have won.
Is there anything you're looking at right now?
We're looking at a number of different situations that seem to be coming up in the pipeline, but this will affect pricing.
Tell us about the environment right now at United.
At Bank United, obviously we put out some public numbers recently. We're doing very well. The market is behaving about the way we expected it to. Unfortunately, we're not seeing any evidence of a recovery in the real estate market in the Southern Florida market. But Bank United is doing very well, mostly as a result of our partnership with the FDIC, and that really working out quite well. We, as you know, we're only required to hold 8% capital against that deal, so this is already a 25% increase in what we would have had to hold.
If you had to put a number on it, John, how many more banks do you think are going to fail during this current crisis cycle, and how long do you think it's going to take to flush them all out?
I've said, starting last year, that I think we'll lose 1,000 banks out of the system over the period of this cycle.
That period being how long?
Over the next 2 years.
2 years?
Yeah. We've already lost 81 this year. The numbers are climbing every day. Now, many of these institutions nobody's ever heard of. They're smaller companies spread around the country. Some of them are Some of them are private. It augurs poorly for small business managers because very large banks tend to lend money to very large companies, and small banks tend to lend money to mom and pop operations.
So it exacerbates
it exacerbates the problem for small business borrowers.
This is the most important issue of the morning that we're discussing, because just to have, so I have some numbers for you to put this in proper perspective. In the 89 cycle, so let's say 1989, 1993, 15% of the banks and thrifts in the United States went away.
That's right.
So far in this cycle, it's been under 2.5%. So there's a lot to come, just to match the 89 to 93 cycle, and this is probably a lot worse than 89 to 93.
It is, and I think we have a short memory about that. That's right. There were over 1,000 banks that failed at that time, and
But that was over almost a decade. You're talking 24 months.
No, it wasn't really that long. That was really over a period of about 3 years.
Yeah, it was. Right.
Yeah.
Didn't we also, between 84 and 94, we lost probably 100 banks a year?
Yes.
During the 80s.
Yes.
I mean, in some sense you say it's going to hurt small business, and yet we've always lost a lot of banks, and yet it hasn't hurt small business so far. So why will this one hurt so much more?
I think because this one, because the trend seems to be that government money has propped up the very large institutions as a result of the stimulus package and the way that it was designed, and there's really very little lifeline available for the small institutions that are suffering under these circumstances, especially in the area. And I know that you've talked about commercial real estate, but lots of the commercial real estate problem resides in the regional banks and in the small community banks across America, because the larger banks haven't participated in that market and haven't fueled the growth in that sector in the past.
So are there enough buyers for these banks, or do we have to sell them all to Spain? Can Spain buy 1,000 of these banks?
That's very interesting, Carl, because this new regulation, which applies to domestic private equity investors, sort of this flies in the face of what we just saw the FDIC award a bid recently that will, by their own admission, result in a substantial loss to the FDIC fund, which is already substantially weakened, and it went to a non-domestic foreign bank buyer. We are seeing more people step up and lobbying bids into these situations. If you recall, in the Bank United deal and the one before it, the IndyMac deal, there were very few people that were motivated to step up and do this. We're seeing more players, mostly as a result, I think, of being attracted to the sector. I'm not so sure that'll continue now that the rules have been ratcheted up.
Really? Are non-domestic buyers affected by these rules?
No, I mean out of the private equity sector.
Out of the private
Do
equity.
you think there's any shortage of bidders from overseas? Do you think there are plenty of people who would line up if they could?
I think that we'll see more bidders from overseas as a result of the problems that we face and where we seem to be going, and particularly centered around commercial real estate. They've been obviously very aggressive in the last couple of transactions, and I think we'll see more of them.
So yesterday we talked with the OCC about this ahead of the vote, and we asked them how FDIC is going to put more bullets in their revolver. Clearly, assessments are going to rise. What's that going to do to bank earnings?
It's going to have a significant effect, a negative effect on bank earnings. It's going to further weaken some of the smaller institutions who are struggling right now, and it's certainly going to add to the problem.
By, some say 25%, somewhere in that neighborhood?
I think that that's conservative.
If the deals don't go down and it does get worse, do you think you'll get a better deal? Where maybe they'll lower capital requirements further for private deals, or a better deal at a later date?
We're still going over the minutes of yesterday's meeting. There are some interesting provisions in it. I think in 6 months they agree to come back and take a look at the standards all over again. So people will be focused on what happens over the next 6 months, and we will see, I believe, some more deals coming to the table through the FDIC pipeline in the next 6 months. So we get a chance to see what the effect of this will be in real life.
Right.
As Rich says, it's not just worth watching, it's incredibly important.
It's very important. I think
Yeah,
it's
it's
critically
certainly.
important, especially for, as John pointed out, for small businesses. I personally think that from an investor point of view, I think that's where the scarcity of capital is right now, is in small business America. And that's where some very high returns are going to be in small business lending.
Okay, thank you very much for joining us.